Welcome back to Give Me Some Truth. We're here. It's a beautiful 40-degree day here in the
it's not
end
40
of April. That's true. It's not. It's end of April. I feel a little malaised because the stock market got crushed yesterday.
Mm-hmm.
It's down like over 800 points. So this morning, as we're watching this beautiful, sunny, cold
February day,
except it's not.
Yep.
And we're going to talk about bonds today.
Yeah. Bonds seem like the right topic for the weather that we've had recently. It's kind of like boring, kind of, just kind of doesn't really get you excited, but, it's still important. Still, you have to pay attention to it, So.
I think just like the weather and your current view on things, I think bonds are a little annoying to you.
They are annoying to me right now.
Yeah.
Well, let's jump into it. We might need some new lead-in music too to the podcast.
No way, I love it.
Yeah, I mean it's you're always about kind of the next thing. How long have we had that? It's been a while now.
Dan's got a great radio voice. Maybe he should come up with something to really pump it up. A little pew 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 and stuff like that. He could dial it up a little bit.
Maybe we should have Griff do like a metal melt your face intro. Yeah, exactly. And then we jump into like bonds.
100%. He needs to work on that. Yeah. I'm liking this idea. Just a solo guitar, just did it. Maybe.
Yep.
I don't know if I'm down with the metalhead screamer guy, but.
And then you could play the trumpet because that's that was your.
Sometimes you retire from things, and I retired.
Put it away.
Rose Bowl.
It's like when Jerry Seinfeld doesn't want to run in the race against the other guy. I choose not to run. All right, we digress. So bonds are the topic of the day because bonds have had an auspicious start to the year, to say the least.
It's kind of like the track runner that's getting started, gets his feet in the blocks, and then just tumbles and falls down.
Falls down.
Yeah, that's pretty much what bonds are this year.
Yeah. We're literally at a loss year to date in the one of the more popular bond indexes called the Ag Index. Depending on the day, right now between 8 to 9%, which is a historic loss in the bond market.
We'll have Dan flash up a chart. We'll have a link to this chart as well. But
right.
Just to take a step back on what the aggregate bond index is, it's approximately about 70% government bonds, U.S. government bonds and debt, and 30% corporate bonds.
Right.
So it's supposed to give a good representation of the overall debt market.
Right. It's what you would, in most cases, kind of measure your bond portfolio against. It would be a good kind of litmus test to see how am I doing. And so we always used to say that a bad year in the bond market was down 5%. I mean, that was kind of what we would use as a comparison to a bad year in the stock market. And so you can understand, down 8 to 9 that in year to date, we're not even to May yet. So, it's unbelievable. So let's talk about why. And I think that it's important and maybe elementary for some people listening, but just the idea of when interest rates go up, bond values go down, and kind of why that is and really what that means, right? So let's just take a very rudimentary example, right? So let's take GE, General Electric, and they issued a bond 3 years ago, right? And this is hypothetical, right? So they issued a bond 3 years ago, and stamped on the face of the bond was a 2% yield on that bond, right? So that's what you're going to get is 2%. And today, let's say that they're going to issue new bonds, and because interest rates have gone up, they're going to stamp, say, 3.5% on the face of the bond that they issue today. Okay.
Same thing, 3-year bond.
3-year bond, everything, all the variables stay constant with the one that was issued, 3 years ago. Well, obviously, the one that you have from 3 years ago at 2% stamped on its face is going to be worth less than the one issued today, because why would I buy your bond when it has 2% stamped on the face when I can buy a brand new one that has 3.5% stamped on the face? So therefore, the value of your bond is less. It's gone down. You'd have to sell your bond for less than what you paid for it to make it marketable compared to what today's bonds would go for. So when interest rates go up, bond values go down because I can get today's interest rates on a new bond, and I don't have to take what the interest rates were, say 3 years ago or 2 years ago or whatever the time period is. So,
yeah, and the one thing to note there is that's bonds are marked kind of to market, and in other words, they're valued every day. But in many cases, unlike kind of unlike stocks, you have this stamped coupon rate that you're going to receive. And you're going to receive that, maybe it's on a quarterly basis, maybe it's on a monthly basis, but you receive that income and it just continues, and you can just hold the bond until maturity. So in your example, if you didn't sell it,
right,
you'd get your yield,
the 2%,
your 2% yield,
yep,
and you just get that, and then
your money back.
And your money back. If you put 10 grand in it, you get your 2%.
Right.
The whole way through, you get your 10 grand back. Done. And you really didn't lose anything at all, as long as GE is a going concern. They didn't go out of business. And then also that you didn't sell mid-period. Right. So you're fine if you just held it. Now,
yeah, and I think that's a good point that you bring up. Let me jump in just for a second. So people, I think one of the common misconceptions when I buy a bond, and understand, taking a half step back from this, the reason why this is so such a hot button issue today, relatively speaking, is because interest rates have been falling in the United States you can more or less say for the last 20 to 25 years. Not a straight line fall, but the trend has been down for literally the last 20 to 25 years. And if we go back to what we just said, when interest rates go up, bond values go down. Therefore, when interest rates go down, bond values go up. So the bond market has been performing well for literally the last 20 to 25 years, right? Now, that's a pretty blanket generalized statement, but that's more or less what's happened. And so the fact that we have interest rates going up now and we have bond values going down is a whole new animal for a lot of people. A lot of people have lost sight of the fact that you can lose money in bonds. And you're seeing right now that you can lose money, and you can lose a lot of money in bonds, like people did in the 70s and 80s when we had an almost an unprecedented at that time rising interest rate market. So let's pause and we'll ask our non-financial advisor, Danny, does that make sense? Okay, we got kind of a mostly yes. All right, so we haven't lost Dan yet, so I think we're in pretty good shape. We can keep going.
Yeah. Now, if you take that, we kind of said something about an individual bond.
Yep.
And you can do those. You can buy treasuries, you can buy corporate bonds, you can do all that. But most people don't.
Right.
Don't
buy an individual bond.
Don't buy an individual bond.
Right.
And I do think there's a case now for it, and that's for a different podcast. But I think there is a case for buying individual bonds, particularly government bonds presently. But if we look back at kind of how most investors are constituted, they buy a fund. Yes. So that's why, they have all the bonds inside of the fund are valued every day. And that's why you can see your fund adjust its valuation every day. So basically the fund price will change, and all of the bonds inside of it are priced, and then that rolls up to the overall price.
Right. So a good example of that for a visual for people would be, think of a bond fund, for example. That's a grocery cart, right? And all of the items that you've chosen on your grocery trip that day, those are the bonds inside of the cart, right? You're just buying the cart. You're buying everything that's inside of it. And it might have some treasuries. It might have some corporates. It might have some mortgage-backed securities. But you're buying a basket of investments that are not all the same. Some have short periods of time attached to them, known as maturities. Some have longer ones. And so you're getting kind of a mix. And so to your point, Clint, most people are just buying a bond fund and then getting the cumulative effect of the bonds that are held within that fund.
Correct. And it's usually kind of tied to a certain goal. If you're buying, say, index funds, you could buy a mortgage-backed security fund. You could buy a treasury fund. You could buy a long-term bond fund that could be long-term corporate bonds or long-term treasuries. So the places that have gotten hit the most during this downdraft have been the longer maturity, as you can kind of imagine. So you're taking more risk the longer you go out in bonds, because interest rates are very uncertain over a 30-year period versus, a 1-year period.
Right.
So, and the Fed influences the very short-term side of the curve. So the Fed, is really this discount rate, this super short rate. The Fed does have an influence through that, but the Fed really doesn't influence long-term rates at all. The market determines long-term interest rates. So, that can be a bit more volatile on that side of the curve. So longer dated securities have gotten hit pretty hard. So the aggregate bond, the duration of that is kind of intermediate duration to long duration. So, when you gave the example, like right now I'm looking at the sheet, it's about 8.5% that it's down, and that's total return. That is including the interest being paid by the bond. That's how bad it's been.
So, positive of the interest being paid on the bond, and you're still down 8.5.
That's right.
Right.
So, that's a bear market in bonds, really, because they're, 20% down is the bear market in stocks. This is certainly what I would consider to be a bear market in bonds right now. So, how do you mitigate that? Well, high quality bonds have generally done all right. Although I looked at it, high yield bonds, and it's not on this chart, but high yield bonds have held up fairly well because they pay higher interest rates. Right. So the more credit quality, the more credit risk you take, the higher you have to pay. So it's like, if Nate had a 500 credit score and I had an 800 credit score, who's going to pay more for that? Well, Nate's going to pay a lot more in interest rates. So same thing with companies. So they're going to have to pay more. So that helps offset when they don't go bankrupt. That helps offset, the credit risk you take, and it helps offset some of the losses that you have from the duration risk. So, those are some of the things that you can do to help mitigate this. You could drop your credit quality, which in this environment, I don't know. That's a risky proposition. The other thing that you can do is shorten your duration, right?
Right.
So you're saying, I want to stay shorter on the curve, give myself more certainty. And actually in this environment, we tend to, just as a general consensus in the office, believe that right now we're better served in short-term bonds because, there will be a period of time where interest rates increase, and perhaps then we add duration back. But at this point, it probably makes more sense to be on the short side, just in our opinion.
Yeah, because the bonds mature faster, so you kind of get to hit the reset button, if you will, and buy a fresh new bond, like we illustrated with the GE example. You get to do that sooner, right? So if I have a 2-year bond versus an 8-year bond, I only have to wait 2 more years before I can reset to whatever today's rates are. Versus an 8-year, I'm locked into that, and there's nothing I can do until I get to that point, right? Other than sell it, and again, then I'm going to probably sell it at a loss.
Exactly. And just to give people some examples, I ran a couple different things, and these are all really high quality type of bonds, just showing generally how they've performed. Mortgage-backed securities are down about 7.5%. I'm seeing like 7.66. Again, Dan will flash this chart up, but the TIPS index, which is Treasury inflation protected securities. So some people go, well, okay, I know inflation's high. I just want to buy some inflation protected securities because it says it in the name. Well, those are actually really long dated bonds. So that's even down 4.7%. Sure. And then if you bought short-term TIPS, so short-term Treasury inflation protected securities, that actually has performed the best. It's out of all the ones we've shown here, about down right around 1%. So, even that hasn't avoided loss. So no matter where you've been this year, you likely have lost money in bonds unless you're essentially in cash or short-term paper. So
right, and the silver lining here, and we'll honestly bring this to a close, because if we go too long in this conversation, people will fall asleep while driving.
I know they love bonds.
They'll fall asleep literally. So the silver lining here is that if the Fed continues to push rates up, and it appears as though they will, because it looks as though inflation is going to be a problem for the next few years, likely not the next few months. They're not going to fix this in the next couple months. It's just probably not going to happen. So the silver lining here is that we could actually get into a position where we could make a solid case for buying individual bonds and just saying, yeah, let me have that 10-year treasury or that 5-year treasury that might be paying 3.5% by the time we get to the end of the year. That might look like a pretty solid deal, because as we said, as long as you hold it for the life of the bond, and whoever issued the bond doesn't go out of business, you're getting your money back. So that's a pretty solid space, and we've not been in that space for a long time, and that's the reason also why CD rates have been so low for so long, is because rates have been so low for so long. And so, when's the last time you could get 3.5% on a CD?
Been a long time.
Literally been probably 2000 mid early, the aughts, if you will, right? 2004, 2005, maybe something like that, right? 2006. So that's the silver lining, is we might get into a spot where the bond market, if we have cash and we want to buy bonds fresh off the shelf, if you will, that might actually turn into a pretty pretty good decision here coming up.
Exactly. So we wanted to give everyone just a short sort of thing on bonds right now, and we'll be back with a little bit more on bonds in the future. So thank you for joining us on another episode of Give Me Some Truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.